Hey everyone, my name is Sean Grun, and for my final case analysis project, I am doing it on Campbell Soup Company, where I'm a current senior financial analyst. So just a quick background, they were founded in 1869 by two guys named Joseph Campbell and Abraham Anderson, and these are some of the products they started producing: canned tomatoes, vegetables, condiments, mincemeat, soups, stuff that would uh, be well off in cans. In 1922 is when they kind of adopted the name of Campbell Soup Company, but after they've been producing soup for many years. We are currently headquartered up in Camden, New Jersey, which is just outside of Philadelphia. In 1961, Campbell Soup acquires Pepperidge Farm, and in 2018 they acquired Steiner's Lance. Since the acquisition in 2018, Campbell's kind of reports in two separate divisions, one meals and beverages and the other in snacks. And in fiscal 2020, they had a net sales of $8.69 billion. One fun fact about Campbell Soup is 95% of all Americans have a Campbell brand in their home. And on the next slide here is where we will see the brands. So as you can see, the bottom row, there's a lot of brands there that you're probably familiar with, like Prego, the SpaghettiOs, the Campbell Soup at the bottom right, and then as you move up one row, the Swanson broth, as well as Pop Secret popcorn. Then up another row, the Lance crackers, Pretzel Crisp, V8 Juice, Goldfish, Milanos, and then at the top, Snyder's Pretzels, Cape Cod, and then the Late July organic tortilla chips. So they're all pretty well-known household names that Campbell's has expanded into, and like I said, now work in a meals and beverages and snacks division. So kind of moving towards a more balanced set of revenue, as both in 2020 they were about 50-50 in revenue for both the meals and beverages and snacks division. Looking at the EFEM matrix here, so under opportunities, the first two kind of go hand in hand, so I'll just do them together. So consumer spending is expected to increase 2.1% from 2016 through 2021, and per capita disposable income is expected to increase 3% through 2021. They have the same weight of 0.05, but a rating of 2. I think it's an important rating because as consumers continue to get more money, they may have more items in their house that they normally wouldn't have. They don't see as primary, such as chips and pretzels and popcorn, but they could also spend it on other things that don't involve going to the grocery store. Next is the snack food growth annual rate of 6.8% over the 5 years to 2021. It has a weight of 0.04 and a rating of 3. It has a lower weight because it's only for snacks. It only accounts for about 50% of the revenue, but the rating is higher because of the potential growth there, as the snack division has well-off brands and has a pretty good market share. Next, innovation of healthier products as well. So a pretty big weight as the consumers continue to move towards healthier product lifestyle and have just better off brands. And then I got a rating of 3. Campbell's is continuing to do innovation. So I think one, if you go back to the brands slide, on the first column, the soup cans that say yes on them, they're a healthier soup that is out for the consumers in a smaller size. It's kind of like on-the-go soup. And then the organic tortilla chips for Late July, I think, are a better option than some of the Tostitos brands as well. So next, continue to focus on snacking domestically, as exports are only estimated to be 3.2% of revenue in 2026. It has a rating of 0.04, once again, only because it's just for snacking and the snack side, not for soup. It has a rating of 3. I think Campbell's does a good job of focusing on snacking domestically, so within Latin America, the United States and Canada, and kind of focusing on that as the main source of revenue and not looking overseas. There is some potential for some untapped market, but I think most of it is kind of dominated by snacks in those countries and bigger players in the market like Lay's, who's owned by PepsiCo. Next, the long shelf life of the product portfolio could be a huge benefit in going to the e-commerce, as a lot of consumers are pushing towards online shopping. So if you're pushing to online shopping, such as Amazon or even out of your local grocery store, they can have more product in their warehouses. Even though they like to push it out, but they can have the product there longer since it is a longer shelf life. So if it has a weight of 0.06 and a rating of 2. I think Campbell's is working on it, getting most of the products in there, but it's just making sure that most of the consumers are aware that you can order these products online, and they'll be at your front door whenever you're doing your shopping. Next, potential M&A with new entrants or smaller, more established brands. Give that a rating of 3 and a weight of 0.05. So like I said, in 2018, Campbell's had bought Snyder's Lance, who had a pretty well-known product portfolio for snacks, and it's kind of helped them within their revenue in the consumer packaged goods industry kind of keep pace with some of their competitors like General Mills or PepsiCo or Mondelez. So if they can kind of continue to do some of these M&As in order to gain some more market share, I think it'd be an important step forward into the future. COVID-19 forced the economy to shut down and forced people to eat at home, and so this kind of has made the potential gain from customers during the pandemic an increase in cooking from home. So I gave it a weight of 0.06 and a rating of 3. Campbell's has recipes online with our products where we can look at or you can use our products and make your own recipes. So I think if we can kind of keep some of these customers back in during the pandemic, I think this will help the top line growth. So smaller one here, they own V8, which is a healthier option for juice. It's expected to grow 1.3% from 2020 to 2025, so a little bit of growth. Once again, it's got a weight of 0.03 because it is a much smaller company or a much smaller segment of the business, and a rating of 0.2 or rating of 2. I don't think we're kind of pushing that as the main source of revenue, but it is something that is continuing to grow. And then another opportunity is promoting social media as a way to decrease marketing expenses. I think we do an okay job of promoting that, but I know you got to pay for some of the spots you want as well. So it's got a rating of 0.04 or a weight of 0.04 and a rating of 3. And some of the threats, barriers to entry for snack foods is kind of are medium because of the taste in consumers, and someone can just jump in much easier. So it's got a weight of 0.03 because it is just snacks, not affecting the whole company, and a rating of 2. I think there is a potential here, but it would take a little bit longer since the snack industry is so widespread. Health expenditure is expected to increase at an annual rate of 2.6 over the 5 years through 2021. Like I said, this has a weight of 0.1 and a rating of 3 just because every product in the portfolio I wouldn't say is the most healthy, just based on the facts. And if Campbell's doesn't continue to improve the healthier products, then this is going to be an issue going forward. Government regulations could be a big threat to produce healthier products, and what goes into products and what doesn't. That's got a weight of 0.06 and a rating of 2. The stock and broth industry revenues are expected to decrease at 0.5% through 2024. It's got a weight of 0.04, rating of 2. That one section of the industry, and I think it's a pretty big one because it is that segment makes up 50%, not the total 50% of the revenue, but it is something. High competition from the main competitors like Progresso and retailers promoting their own brands. So like I said, soup is a pretty big player within shelf space, so being able to promote your own brand and making sure that the revenues are still there. New tax rate could increase. That's going to increase your overall operating revenue from the very bottom, so hopefully that doesn't come into play within the next coming years. Pricing pressure from other competitors on similar products. So I guess it's a pretty high. It's rating of 0.03. I think all the pricing for a lot of snacks and soups are pretty similar. It just kind of depends on which one you prefer. So I think we do a pretty good job on our pricing, but it's a low rating. One could be a weakening of brand loyalty, like I mentioned, in the snacks industry, there is a lot of snacks that are becoming more popular just because they are healthier or just personal preferences as a push towards healthier snacks. So it could be something that continues to change, and as well as soups. Campbell soup is a staple in households for a lot of the 1950s, 60s, 70s, and 80s, but now as you kind of see the unhealthiness and the healthiness change of the consumers, it's kind of pushing it forward. Power has shifted towards the supplier and could cause an increase in raw materials. This is a pretty big weight, as this could have a massive impact on what goes into the cost of the product and could overall impact our net income. And then once again, hand in hand would be increase in labor wages, which would potentially cut margins. So overall, I think on the external factors, Campbell's gets a 2.35. And for their strengths, they have a strong brand portfolio across all operating segments. Like I mentioned on the second slide, they have really strong brands that are staples in many households, and 95% of Americans have one of the brands in their household. So I think from 2019 to 2020, we were able to decrease our debt levels by 30.3%, I think, which is big, which would free up cash flows and the issues and put it back into the business or have a potential M&A. Production and distribution facilities across the U.S. makes it much easier for us to get our product where it needs to be. I'll say brand loyalty is big. I know I touched on the last slide, but I think with some of the soups and chips and pretzels and the broths, you do have the continuous customers. They like the way that it tastes. Strategic divestiture of a business that was not doing so well overseas kind of pushed up the cash and then helped us rebalance on the balance sheet, which gave us more money into our retained earnings as well as cash. Strength, product innovation. I know there's always new products and new commercials coming out for these new products that we want to make people aware of, as we want to push towards a healthier lifestyle and new flavors. So I think overall we do a pretty good job of that. Big one here is continuous dividend payment. I think it provides steady cash flow into our company, where it's saying no matter what we're making or not making, this is what you're going to get as a dividend. Another big one would be synergies with the acquisition of Snyder's-Lance. Like I mentioned, it's now 50-50 with revenue between meals and beverages and snacks. So being able to kind of integrate snacks into the mainstream of the production and distribution facilities would be a huge help. Marketing expenses continue to increase and can still continue to promote our products and make sure that the product names are getting out there. And we have overall low production costs that go into the final product, so our margins are pretty high on some of our products. And then moving into the weaknesses, our soup sales declined or stayed the same for a few years. So I think that's pretty important, as it is close to 50% of the business. So it is something that we will continue to focus on. I know it's been a big focus for the company. There is still a low cash position, even though it has increased. It still needs to be a little bit higher, as the debt is still significant enough to where it's an overbearing amount where we can't really pay it off or invest into the future of the firm. Global presence is lacking. I think we missed out on some of the potential markets that are overseas just based on how we have focused, but we're continuing to focus on some of those, or continuing to focus on the North American segment of our revenues. Seasonality is huge within the product portfolio. When you think about it, soup is only really reliant during the winter seasons, as well as we have stuffing. So during like Thanksgiving and Christmas and Easter, and then some of our chips are more in the summer. So I mean, I think we have to hit our sales specifically in those numbers or in those seasons in order to get to where we need to be. So we have a lower PE ratio than the industry average, which is basically saying the market doesn't see as much growth for the company than compared to its competitors. I think it's a big rating. I think we're kind of working on it with the acquisition of Snyder's Lance in order to kind of help out with the revenue growth. This is a big one. Slower increase in gross profit than net sales. So it just means in that bottom, in between the top line and bottom line, there's a lot of stuff going on. So increase in marketing, increase in cost of products sold, SG&A, all that, and then next is growing interest from consumers in store retailer brands. Some people are pushing towards, I know grocery stores are pushing towards selling their own products and giving their own products more life space or more shelf space in order to kind of help out with some of the losing shelf space of the other products. Your capital expenditures in 2020 to meet environmental demands. I mean, this is going to be a continuing thing, and for our plants and even some of our other businesses, in order to become green buildings, we're going to have capital expenditures in order to meet that. Big one, 44% of revenue comes from 5 customers. So like I said, if one of these customers continues to push their own store brands more, then we could lose some shelf space and then lose some profits. And then due to COVID-19, there's a shortage of inventory levels just because of the products that we have. So soup was a big one to kind of stock the shelves of the consumers. So as you can see here for the IFEM, the overall weighted score, I think we're doing average is a 2.5. So next on the competitive profile matrix, here are the 3 brands that I chose. So obviously Campbell Soup Company, General Mills, mainly because they're the main competitor for soup. They own Progresso, and then the last is PepsiCo. They own Lay's and a big portion of the snacking industry. So under brand recognition, it was close, but I think PepsiCo kind of wins overall just because of their name. I think Campbell Soup does a little bit better of a job of some of their brands that they own. And then General Mills is last at a rating of 2. Market share, this is just based on market share within each of the segments. So PepsiCo has the largest in snacks, General Mills has the largest in soup. So overall, I gave Campbell Soup last. Customer loyalty, kind of tough, but I would typically say for PepsiCo, they would go back to their snacks, their Lay's, their Doritos. And then for Campbell Soup, I think you do the same thing. I'm a big fan of the kettle chips and the Goldfish and the Milano, so I typically continue to go back to those. And then General Mills, a little bit off with the soup. I feel like it was kind of a toss-up for soup, which one you go to, but I would pick Campbell Soup just based on the brand. R&D, I'd say we have pretty good R&D just based on what I see on the shelves for products and kind of what we're doing to change how we kind of interact with the consumers. So like I said, we have a new soup called Campbell's Yes. It's much healthier to-go size cup soup that people can use. Pepsi's, I think, almost there with they're kind of innovating some of their new chips like the baked Lay's, be a little healthier. And then General Mills, I didn't see too many changes in their products. Marketing and advertising, just based on what is commercial-wise I see, I'd say marketing and advertising would definitely be Pepsi, then General Mills just with their products, and then we would be last. I don't see too many commercials unless it's during peak season. Market penetration, Campbell's got the 3 here because of what they're doing with their products. They're coming out with new products consistently in order to kind of gain some more market share and increase where we are within the snacking industry. Product quality, I think overall quality is pretty good here, so I just kind of went on what tastes the best. So I'd say Pepsi probably would be the best product quality, and then Campbell's, and then General Mills. Health-wise, I think we would barely edge General Mills here, mainly because of the Well Yes soup, and then For snacking, I'd say just because of the way our snacks are and the product innovation we have, I'd say we got a little bit better of healthy products. Financial position, Pepsi and General Mills much better. They have much higher cash flows, much more revenue coming in. And then price competitiveness, I think our prices overall are pretty good. So I think we are cheaper than a lot of the Pepsi products, and then General Mills and Campbell's was kind of a toss-up on soup. So overall, the winner of the competitive profile matrix was PepsiCo, just based on their strong brand and what they're doing in order to kind of promote their products still. So here's just a SWOT. So SWOT, same thing, same things used for the what was using the IFEM and the EFEM, and same thing with the opportunities and threats. But here are the strategies that I came up with. So focus on retaining customers gained during or gained post-COVID. So I think it's a big one. In order to kind of keep some of that revenue that we saw, we need to have those customers continue to buy the stuff that we want and continue to cook at home. Continue to promote strong growth of the snacking industry. I think we need to continue to push out new products and make the products more well known and say this is what we need. Fight for the shelf space near the Lays and the Doritos of the PepsiCos in the industry in order to kind of take some of the market share. And the last is utilizing excess cash and continues to look at strategic M&A. So the excess cash can either be put back into the business with an M&A or integrated within something to get some more just to get more product on the shelf and kind of increase products. So some strengths and threats. Invest more into the soup as the whole industry is struggling. If we can kind of push this market, we can continue to gain more market share and can keep ours and maybe even have a slight increase in sales. Innovate new products. This is huge. It's been mentioned a lot, but like I said, the consumer index is supposed to increase. And while it's supposed to increase, we have to keep up with that, or else we're not going to have any sort of gains on the products that are going in and out. So I think this is a big one in order to kind of keep the market share. And last, provide wealth to shareholders with a consistent dividend payment. This kind of shows that we're still there for no matter what we make on revenue, just kind of increase some of that. And then, so now with weaknesses and opportunities, we got to push more product in e-commerce. It was already mentioned, but I think a lot of people are doing the online shopping, get it delivered to your door, so we can have those products at the Amazons and online and have them in the grocery stores. I think that we can kind of push some of this. Snacks industry to help enhance growth opportunities as well. Once again, we need to push this industry and get some more volume into the stores in order to increase our top line. And then potentially invest overseas in a established brands to gain market share. There's not a lot of market share that we have over there. So in order to gain some of that, I think increase revenues and kind of push towards some of that market share where General Mills is. And then next is promote green and environmental changes within the company. We got hit with a big number last year based on what I saw in the 10K. I think it was close to $300 million of green changes that we had to make to some of our buildings. So if that continues to happen, we're going to have to keep investing cash into that instead of putting it back into the business for products or M&A. This is kind of a push, but I'd say increase or invest in co-manufacturing for store brands to help gain revenue of soup industry declines. So like I mentioned, a lot of people are pushing towards, or a lot of stores are pushing towards promoting their own brands. So if we can be part of a co-manufacturing for them and kind of help gain some of the money from them, then they can have the sales, but we'll just get a piece of the pie from them. And then innovation of healthy products to reduce seasonality. I think this is big. So like I mentioned, prior. Soup is pretty seasonal during the winter time. Same as stuffing, but if we can kind of help move back some of the chips into being year round, as most people know, chips are probably eaten more in the summer, like tortilla chips. So kind of increase some of the healthier products that reduce the seasonality, where we're not reliant on some of these months to hit the sales. So 4 recommendations. I said increase R&D and healthy new products by 8% to provide just more income, or just to provide a little bit of help going forward as the market continues to push towards a healthier product. Acquire well-known snacks or a healthy soup company. Increase marketing by 30% for product awareness. Spend $300 million on environmental enhancements, as we already did, but spend more in order to kind of get ahead of the game. Invest $50 million in a push towards e-commerce. Invest $300 million into marketing research for millennials to gain insight on new product innovation. Promote online recipes and in-home cooking with current products. And invest $100 million into revamping current soups to make them healthier. So in the end, I picked the ones that have the star next to them, so 1, 2, and 5. So here is the QSPM. My 2 alternatives I said were increase your R&D expense or acquire a healthy snack or souping company. So on opportunities, I gave snack food annual growth, both of 3. If we increase R&D and acquire a company, I think they'll both be about the same. Just depends on how much you want to look at it by. Innovation of healthier products as healthy eating is expected to rise. Once again, I think the same as above, but I think increasing R&D as we have some of the products already available to us. It's just a few slight changes. I think that provides a little bit more of money savings that would come in. Continue to focus on snacking domestically. I think that's big. Increase your R&D and do what we already know what works here. And then as well as a snacking company, that what works here best would be about the same. Obviously, next one, M&A. 4 for a rating on acquiring, just because it works better. Shut down of the economy. Once again, COVID-19. I think if we increase the R&D in this piece or acquire a company to help gain some of those customers, it'd be big. V8, once again, not a big portion of the revenue, not a big expansion on growth, but if we can increase R&D and kind of get a juice out there that is liked by all the customers, or we can acquire someone as well, I think it'd be a big push towards helping with some of the revenue. Next is threats. So under threats, barriers to entry are medium. So I mean, if we just keep increasing the R&D, kind of get the products out there. But if we acquire a company, I think it would be more beneficial, as it would continue to help just the barriers to entry of a smaller company that would be kind of gaining steam within the industry. Touched on it throughout the whole presentation, but health expenditure, continuing to innovate products is big, and as well as acquiring a healthy snack company, I think they're about the same. Stock and broth industry, so once again I mentioned it, increase your R&D to kind of push towards a healthier soup, take out some of the sodium in the soups, increase more products like the Well Yes brand. But then if we acquire a company as well, it'd be a little bit easier. You don't have to spend the money on the R&D, and you already have a well-positioned company within the industry. The strengths here, brand portfolio, nothing's going to change with R&D, so it's about the same. And then if we acquire a company, it's got to have a strong brand. Decreasing your debt, so which would increase your potential monies to put back into the company. I think the ratings are about the same. Brand loyalty, customers are already familiar with our brand, so if they see new products that are healthier, they're more likely to buy them than seeing a new brand they haven't seen, even though it may be healthier. So I gave the edge here to brand loyalty. Divest, adding more cash, both products are going to be the same on this one, or both alternatives would be the same, just because cash would go back into R&D as well as going into an M&A opportunity, and product innovation obviously would go into the R&D instead of the merger, just because of we already are well positioned within the market. So just the R&D and updating some products rather than buying a whole new company we would be positioned much better. And under weaknesses is soup sales are slowly beginning to decline. So once again, increase your R&D or buy another company that would help kind of make up for some of those lost revenues. Low cash position. This hurts. I think doesn't hurt as much just because the increase isn't as high for R&D. So I gave it a higher rating or higher score, and it'll hurt with the M&A because we'll have to take out more debt most likely in order to kind of pay for this company instead of paying with all cash. So unless we can increase our cash flows into the company and increase the retained earnings, I don't see that being too feasible. And last, slowing of the gross of the net profit only grew 5.2%, while sales revenue grew 9.2%. This one here is big just because it'll still impact that bottom line if we increase R&D. And then hopefully the sales can recover for it. So I gave it a 3 as a first score, and then I gave the 4 to acquiring a new company because then they already have all the products and costs going in. So it's just kind of continue to run, and hopefully we can push more product in and gain the revenue. Overall, the total score, I got a 2.8 and a 2.72. So it would mean that investing in R&D would be a much better option than acquiring a new company. Next, under the EPS and EBIT, what I did for the amount of capital needed, I added up whatever was needed from 1, 2, and 5. I subtracted last year's EBIT and added last year's EBIT, and then took a realistic number as well, so just took an average of the two. Interest rate was 4%, tax rate 22.7%, and then I used which was last year's tax rate, and use the stock price as a close of business on Friday, 4/23, and then number of shares outstanding was the current number of shares outstanding. So it looks like all debt financing would most likely be the most feasible, just because we do have an okay credit rating with Moody's, but it comes down to whether or not we can afford some of the debt that we want to take out, just because we already have high debt levels, and we did pay a big chunk of it off in the last year. Next, here is the projected income statement. So what I did for revenue, I took a weighted average of the revenue for both segments and came out to 3% annual growth. So like the 6.8%, the decline in sales for soup, and then the increase in meals and beverages kind of average those out. So that's what I got for projected 2021, as well as did the same thing for the cost of products sold here in the R&D, except I added 8% based on what we did for the increase in R&D, and then for restructuring and other expenses kept the same. Interest expense just kind of used the run rate for all this, and so overall you can see there's a decline in net income, but mainly because there is no earnings from discontinued operations. There was a sale that hit the company last year, so we got a big increase in net income. So I think we'll continue to see kind of the net income level out, depending on kind of how it all changes out. But I think this net income will kind of decrease a little bit. And next, for the balance sheet, a lot of this is used as run rate, but so a lot of the current assets, just not really a significant change in the balance sheet from 2019 to 2020. I added in the R&D investments into the intangible assets, saying that with these new products, it's kind of going to help us with some of the R&D, and It looks like most of this is using run rate, and then as well long-term debt. I increased long-term debt by 625 million because we were told in EPS EBIT to increase that, and the change in retained earnings was based on the continuous dividend payment of 1.40 and the change in net income, so the increase in cash as well, hopefully be put back into the business, which was a plug for all of this. And last, for the conclusion, I said Campbell Soup, we will definitely need to continue to adapt to the customer in order to keep market share and grow revenue. I think if we don't adapt, we're going to get stuck in some of the old ways and kind of get forgotten and lose market share and lose revenue. I think we're in a good place compared to our competitors as we're coming out with consistently new products that continue to be healthy. We do have still some of the traditional chips that we have, but we do have some that are coming out to be more healthier. We need to invest money and then reinvest money back into the business. I think that's huge in order to help push towards the healthier lifestyle, but then also just kind of help with some of the other stuff that's going on within the company. And another big one, find a way to engage millennials in some of the products. I know a lot of millennials have their own brands they like. They're a smaller brand because they're healthier and they just taste better and stuff like that. So I think we need to engage in some sort of marketing with them to figure out what would be the best way for us to gain some of that market share. And that is my final case project on Campbell Soup Company.